Welcome to this short lecture on the break-even point presented by Stratfield Solutions as part of our Understand Managerial Accounting in 5 minutes mini-series. So the break-even point is a managerial accounting concept which tells us when we have recovered all of our fixed cost by contributing enough leftover revenue after subtracting out variable cost. And it's where the net income of the business is zero. So we make exactly enough in contribution margin to cover the fixed cost, and the result is that the net income of this business is zero. It can be calculated in units or in dollars, and we'll go through the ways to do both of those. And what we use is fixed expenses, variable expenses, sales, or if you have it, contribution margin. So a word about contribution margin: if you don't know how to calculate the contribution margin, this is a concept you have to understand before trying to solve a break-even problem. If you don't understand what contribution margin is, we have a link to our 5-minute contribution margin video in the video description below this course. So I would highly recommend you check it out there before going any further, as we will be using the contribution margin as part of calculating the break-even point. The next portion is to determine whether or not you want to solve for the break-even point in units or the break-even point in dollars. It can be measured in either, and it's common to see both of them in practical applications as well as in accounting textbooks. You can convert the units into dollars and the dollars into units pretty easily, and we'll show you how to do that. And knowing which to use, meaning units or dollars, depends on the question that's being asked and the way that you need to answer it. For example, a question like how many units are needed to be sold to break even, that would use the units formula. You're looking for the number of units. Or a question like what is the dollar sales at break even would require the dollar formula. And again, you can work in between those two, but depending on the way the question's asked would depend on which of the methods you would look for in these formulas to solve the problem. So speaking of the formulas, the first one we're going to go through is the units. So the break-even point in units is equal to total fixed cost divided by the contribution margin per unit. And this is why I mentioned earlier, understanding what the contribution margin is important. Sometimes you'll see this as FC for fixed cost divided by CMPU, or the contribution margin per unit. And again, this is to get the units of break-even. The other formula is the break-even in dollars. And what you do is you find the break-even point in units and you multiply by the selling price per unit. And there's an abbreviation for that as well, P being price. Now, quick note about a dollar alternative. Obviously, you had to solve for the break-even point in units before you were able to use the break-even point in dollars formula just presented. There is a second way to calculate the break-even point in dollars, and it's by using the contribution margin ratio. We have another video for the contribution margin ratio because this is a little bit of a different topic in the context of talking about contribution margin, and there's a link below this video to go through that calculation, but did want to cover this real quick in terms of the formula. You would use this to directly calculate the dollar amount of sales to break even. You take the total fixed cost and then you divide it by that contribution margin ratio. And again, we can cover the ratio by looking at the other video provided in the description. So for this particular course, we're going to just go for the break-even point in units and then convert that to the break-even point in dollars. So the first exercise we have is ABC company produces one product and it sells for $10. The cost of the product to the company is $4. ABC's fixed expenses this year are $600, and the question is how many units are required to be sold to break even. Well, we first have to find that contribution margin per unit, so we take the selling price of 10 minus the variable cost of 4. That gives us a contribution margin of $6 per unit. And then we use that formula presented in the previous slide, divide the fixed cost by the contribution margin per unit. So $600 of fixed cost divided by that contribution margin of $6. The break even in units would be 100. So for practice exercise number 2, you're going to refer back to that previous example, same fact pattern, but instead of looking for the units to break even, we're going to look for the dollar amount. So we knew that we had 100 units to break even from the previous slide. All you have to do is multiply that 100 units by the selling price per unit. That means that we would have to take in $1,000 worth of sales to have a break even. And from this, you're able to now calculate the break-even point in units or in sales dollars, which are two very important concepts in managerial or cost accounting. So with that, look forward to seeing you in another Stratfield Solutions video soon, and please subscribe to our channel for future video updates. Thank you.